Hello everyone, and welcome to this bobsguide webinar. I'm Neil Ainger, the Editor-in-Chief of bobsguide, your daily FinTech update. Today we're discussing the issue of collaborative risk management and whether it is the future of enterprise risk management. We're very happy to be running this with our sponsors and guest speakers from MICES and Chartis Research. The discussion today will look at the move away from centrally controlled top-down risk practices towards a more collaborative risk management approach, which is based upon encouraging all areas of the bank to take responsibility for risk. This webinar will examine the findings of the latest Chartis research in this area and explore how firms can best implement collaborative risk management. So to introduce our speakers, we'll be hearing shortly from Payman Mestakan, a managing partner at Chartis Research, and Thierry Truche, who is the head of product management, MGR, at MICES. So without any further ado, I'll hand over to our first speaker today. Payman, over to you.
Thanks, Neil. Good morning and good afternoon to everyone. I will spend the next 25 to 30 minutes describing a recent survey piece of research that we did, commissioned by MICES, looking into the key trends in enterprise risk management. As many of you know, the future of the financial industry is very much directly linked to the future of risk management. The financial crisis exposed the fact that many firms were either unaware of the risks they were facing or simply failed to understand them in enough detail. While it is clear that risk management practices need to change and need to be improved, we're finding from the marketplace that still many institutions can't see clearly how this should happen in terms of execution. So the survey that we did, we kicked it off in October earlier this quarter, and it was a period of time was between October and November. In terms of the demographics of the survey, just to sort of give you the context of the participants, we had a total of 137 financial institutions, risk professionals from those financial institutions participate in the survey, which included online survey and follow-up and telephone interviews and face-to-face interviews. The demographics was, from a job function perspective, the respondents included CROs, CFOs, credit risk, market risk, and operational risk. Also compliance practitioners and people from the business lines and both front office and back office. So, a very good representative sample of the employees and stakeholders from within financial institutions. So we were very happy with the range of job functions. Similarly, with regards to the business activities that the respondents were involved in, financial institutions from all market sectors are included in the survey. So we're looking at universal banks, retail, commercial, and investment banks are all well represented. Also insurance, life, non-life, and regulators were also in the group of respondents. From a size perspective, as many of you will appreciate, the way enterprise risk management and risk technology is executed in large Tier 1 financial institutions is often very different to the smaller mid-size or Tier 2 and Tier 3 institutions. So again, we feel we've got a very good representative sample of the marketplace. Just over 10% were financial institutions of over $250 billion in assets. But we had a fair representation from the smaller firms under $10 billion and even under $1 billion. So again, a very good sample of the financial services industry as a whole. And then finally, which should not be underestimated, is we wanted to capture the regional and geographical differences that there are in the marketplace and how ERM, enterprise risk management, is looked at. Again, a very good sample. Probably we can argue the 137 institutions dominated by the more mature financial sectors in North America, Europe, and Asia Pacific. But we had a fair sample also from the emerging markets, Middle East, Africa, and Latin America as well. So what were the findings? On one of our key questions, where we asked about the maturity of enterprise risk management within financial institutions. And I think this is our sort of first major finding from the survey, is that despite the financial crisis and all the new regulations and pressure from shareholders, still almost half of the financial institutions that responded feel that their approach to enterprise risk management is still quite loose and tactical and reactive. So on the top side of this graph, it's good news to know that there's well-formulated and systematic risk management going on in roughly around half of the respondents. But as an industry observer, my concern was the other half. It's a question of, is the glass half full or half empty? So, despite the crisis happening in 2008, we're in 2012 now, and still around 50% of the marketplace feel they've got loose and reactive and unstructured approaches to enterprise risk management, which is a bit of a worry. With regards to what are the important factors driving the ERM initiatives within financial institutions, this is dominated by compliance, national and international regulations, and we know we've had a raft of regulations coming in over the recent past, and they're dominating much of the ERM activities and initiatives. I think it's noteworthy also to look at the fact that risk-based performance management is coming up higher up the agenda, so it's not just purely compliance-focused. The need to link risk to performance and the required metrics around that is a trend that we definitely are seeing in the marketplace. Also, on the same question, the need to upgrade and refresh risk management process and systems. We definitely see that at Chartis. Much of the data we gather around the marketplace is around risk technology, and we're seeing increased expenditure and investment in that. Not always strategic, but there is a lot of activity around risk data management and risk reporting. And the need for greater data transparency. So it's not just about getting the numbers out for the regulators, is around understanding where those numbers come from, and the audit trail around it is an area of importance. When we drill down a little bit more with regards to specific regulations, not too surprisingly, the Basel regulations still very much dominate ERM initiatives in terms of the definition of what's required in terms of process and systems. So Basel II and Basel III was got the most remarks with regards to the next 2-3 years and driving activities around capital adequacy, liquidity risk, counterparty credit risk, and so on. This next piece is one that actually surprised me quite a bit. We asked a question about the level of emphasis given to regulatory compliance versus risk management. And, this is a tension that we've been seeing building up in the marketplace for some time. A fixation on compliance and responding to regulatory requests and visits. And we got the sense that from the marketplace, definitely statistically, 65% of the respondents agreed or strongly agreed that there's too much emphasis on regulatory compliance and not enough on improved risk management. And some of the follow-up interviews that we did with CROs particularly, we got the sense that in some cases, the regulatory pendulum has gone too far, and actually is becoming a source of risk by itself, the compliance risk. And I definitely, from one of the North American CROs that we interviewed as part of this survey, his remark to me was that he's not being able to do his job. A disproportionate amount of his time is being spent on regulatory activity, and actually not doing what he's trained to do, which is managed risk. And that itself, he said, is probably the biggest risk to the organization. So some interesting quotes and remarks we got on the back of this question. With regards to ERM priorities, again, drilling down to see exactly what's high up on the agenda in terms of projects, stress testing and scenario analysis, and the whole area of capital management, capital planning. Not surprisingly, these areas are consuming quite a lot of time and expense and resources, technology resources. Traditionally, some of these activities were, once a year activities, or at best once a quarter. I think the key challenge that we got from the interviews is that the need to do the scenario analysis, the stress testing, and capital planning, the level of sophistication is higher, but more importantly, the level of frequency is putting strains on resources and systems, and that's something that needs to be addressed in the coming years. When we discussed or asked questions around obstacles and challenges, it was most of the common theme that we got was around people and culture, and also data. So data and culture, these are priorities that most of our responses focused on. Also, the need for, and this sort of hits the frequency point that I was mentioning earlier, the need for intraday risk metrics and intraday risk analysis and monitoring is a key challenge. I think that's a big systems and technology architecture challenge, and we're seeing more and more projects in that area. We also asked questions about areas of improvement at a firm level, the linking of risk metrics to behaviors and compensations, and generally getting individuals involved in terms of responsibility and accountability into risk activities is a key driver for success, and it's an area that needs to be improved. The whole idea of having the first line of defense against risk being done at the business lines, at the business levels. I think we got the sense from this survey that during really the Basel II initiative of the mid 2000s to 2008, there was too much focus on centralized risk management and supervisory and policing type activities. I think the market is now shifting towards giving the responsibility, accountability, but also the capability to people on the business lines to manage risks, and the central functions becoming more of a facilitator and enabler. And I think that has various technology implications, which I know Thierry will address in his session later on. So in summary, for us, we see a move towards, for enterprise risk management to happen, there's a need for further collaboration between front office, back office, and middle office. Traditional risk management has been very much done in silos, and there's a need to break down those silos. So from a Chartis perspective, what does collaborative risk management mean? Well, we think it's around creating value through improved risk management and collaboration, breaking down the silos, as I mentioned. The drivers for this, certainly regulation is a key driver, but also there's a need to reduce complexity, increase speed, and very importantly, reduce cost. There's a lot of duplication of activity, duplication of systems and technology, and duplication of data. So for us, the whole collaboration theme is around more integration, more alignment, and using technology as an enabler for that. An area that we think is key, and we've seen a number of interesting projects already in the marketplace from our research, is the whole area of risk and finance integration. I think I touched on it earlier from the survey respondents in terms of risk-based performance management. Well, really, to do risk-based performance management, you do need to bring risk and finance data together and have risk-adjusted metrics, which are not just used at group level, but actually used in terms of day-to-day decision-making and supporting trading activities and business decisions. that requires an alignment, organizational alignment, as well as the enabling technology behind it. Now, this is really easier said than done. Much of the finance discipline and the finance functions in all organizations is based on accounting principles, which are generally backward-looking, and then risk is very much a forward-looking concept. And bringing those two concepts and those two disciplines together in a consistent way, so that you don't have huge definition and reconciliation issues, is non-trivial, and data and technology play a key role in that. So, in summary, from my perspective, collaborative risk management is all about not so much integration, but actually around alignment. I think the integrated risk management, the integration word is a little bit overused in the marketplace. In reality, these functions and systems, in many cases, particularly large financial institutions, they're never going to be integrated, but it's about aligning them and having consistent common language and common data sets, so that people within the organization can compare apples with apples, and they're looking at the same numbers. The key areas that need to be brought together and through metrics and data are finance and treasury that we mentioned, the various risk functions across various risk areas, market risk, credit risk, liquidity risk, which they themselves have got their own alignment and integration challenges, and then finally the front office, where the performance is, where the KPIs and value and customer relationship is handled. All of these need to be aligned through a certain level of risk information and risk collaboration. So from my perspective, this is what collaborative risk management is all about. So a few words about some of the enablers for this. Breakdown of silos we've talked about. Risk data aggregation is a key area. We're seeing many projects and many initiatives around this, particularly to be done in an intraday or real-time or near real-time fashion. Data aggregation is a key challenge. The use of advanced risk analytics throughout the business, so that it's not just a domain of the quants. Use of risk analytics by everyone in the firm to support decision-making is a key enabler for success. Enterprise-wide stress testing. I think silo-based stress testing has been around for some time, but to do integrated enterprise-wide stress testing and coming up with plausible scenarios for the whole firm is a key enabler for success, and this is an area that needs further research. And as I mentioned, real-time and intraday risk intelligence is a very important enabler for collaborative risk management. I'll say a few words about the role of technology in collaborative risk management. I know Thierry will drill down a lot more and give you the MICE's perspective on this. But from my perspective, the key enabler for collaborative risk management from a technology perspective is to do with data. Having consistent data actually is not just about integrated data. There's a lot of noise in the marketplace around big data and data integration, but data aggregation for risk management by itself is a specific discipline, and it's a dynamic discipline. It requires advanced technology with regards to the way memory and data quality are handled, parallel computing, in-memory analytics, and the visualization around it. These aspects of data management and aggregation of data are areas that there's a lot of research around it, and it's still really relatively immature and needs further work. With regards to in-memory analytics, particularly for real-time risk management, I think this is a very important area. I think the development of in-memory analytics is one of the most crucial technological developments for risk management, because it enables real-time updates and real-time decision support. Previously, static central data warehouses and relational databases meant that risk analysis was very slow and reactive and based around end-of-day batch-based analysis. And it required predefined rules and queries. What in-memory analytics does, it allows on-the-fly analysis, particularly around what we discussed earlier, stress testing, where you need to do various what-if scenarios. It requires rapid reaction from a data and query perspective, which the traditional approaches really do not enable. This becomes very important in the Basel III areas, such as liquidity risk management, counterparty credit risk, CVA, and intraday reporting. My final point, before I hand over to Thierry, is, I guess, a bit of a strategic point. The one thing that we came out of this study, probably as the main learning point for us, was that while there are many short-term tactical actions and initiatives and projects taking place, many of them driven by regulatory requirements, and these regulatory requirements typically have got a 12-month to 24-month period when firms need to get the reports ready and get the information and the calculations ready for the regulators. These are relatively short-term tactical actions and often being taken in a siloed fashion, which is fine. It's necessary. These are things to do to run the bank. However, we feel that ultimately long-term success in enterprise risk management is about achieving the strategic objectives of the organization and creating the target technology architecture that enables rapid change and rapid improvement, so that it's not regulatory focused and you don't need to re-engineer and recode systems every time there's a new requirement from a regulator, and it should be compliance agnostic. And getting the balance between short-term tactical investments and long-term strategy is ultimately, in my mind, what's going to mean success or not success in the financial services industry. So that's really my sort of final remark and thought to leave with you guys. Thank you very much. And now I will now hand over to Thierry, who will discuss in more detail the technology aspects of collaborative risk management.
My name is Thierry Truche. I'm responsible of enterprise risk solution at Mises. So we have a solution which is called Mises Global Risk. This is what you see in blue. What I want to talk today is really about collaborative risk management. Of course, all the pieces you see in blue are very critical in the context of enterprise risk. For instance, you need data management, and you need to do it correctly because as a risk manager, the end result depends on what you have as an input. You will need different valuation tools on top of central repository, whatever it's credit, market, liquidity risk, advanced measures. All of this is really critical, as well as the finance part related to ERM, for instance. But my point today is not to go through each of these components, but rather to talk what do we mean by collaboration, what do we mean by risk management, and why we should look at this. In fact, we have commissioned Chartis to provide an independent feedback on what we have seen in banks, which is basically how to provide more risk collaborations. Because as a software firm, we always have to think how our software can help risk managers in their daily life. The point here is somehow we've seen more and more that our lab tools, even business intelligence reporting, were not really seen as a great tool by banks. It's good, it provides some things, but it looks like it's not sufficient. And in fact, we have seen over the last few years a kind of shift in the mind of risk managers, CROs, and so on. the need that we really see more and more, and this is what you see in this survey, is that people need to find faster an answer to their questions. They really need to deeply understand their risk, and that's why we have come with this concept of collaborative risk management. In fact, what is collaboration first? Collaboration means working together for a common purpose. So, as a risk manager, if you want to really work for one purpose, which is to assess your risk and to be in a position to report the risk to the board, then you need to first to speak the same language. The same language as, for instance, traders. They need to understand what you are talking about. You have, as a risk manager, to be in a position to explain to others the risk measures and to exchange information. You have to be trustable. You have to really understand deeply the measures you are using. Let's be clear. Maybe 5 years ago, people may not ask you what is behind the VAR number, for instance, the value at risk numbers. But right now, if you come with a figure, you will be challenged to explain what is behind this. So you need to have access to the details, for instance. So, in fact, the idea of us was to create a piece that we called MGR Hub, which answers this issue of how to better collaborate inside the bank for everything which is related to risk. If you think about the goal of the risk manager, of course, we know that the first goal is, of course, to compute risk measures to comply with regulations. That's what I would call the basic. You have to do this. We know it's not easy, but somehow it's more or less achievable with whatever the systems you have, complexities, some time. But the real question behind this is that if finally you succeed in computing the figures, is it really providing added value to the banks? Is it simplifying the life of the risk manager, of the board? Can they take decisions based on their risk appetite? Have they all the information? So the real goal for the risk manager is really to assess the risk of the bank, to understand it, to control it, to even forecast what may happen, so that the decision maker can quickly decide what they want to do. So somehow I can summarize this by better serving the business, which is also going through helping the traders. So in this presentation, I just wanted to illustrate this point by taking one example, and which is this endpoint, which is really when you have computed your figures, how can you use those figures and how can you make them more available to the others? How can you get more added value from this? And we will see that it's not really an easy question. Here, I'm back to the first question, which is reporting your figures is great, but is it enough? Is it enough? Because key question from the bank is how your risks have evolved. If basically the risks are the same as last month, last year, from a bank perspective, it's more or less okay. We have the same risk, we are in the business as usual, that's great. But if the risk has changed, or if an event is happening in the market, you need to forecast and to quickly understand what may happen. You need also to be in that position, you need to be able to drill down in, most of the time, not basic measures, but very complex measures. And here, for instance, if we take a very simple example, for instance, let's imagine you want to understand your value at risk figures. We all know that the value at risk figures are not additive. So when you want to drill down through value at risk measures, it can be quite complex if you don't have the right tools. Because the key question behind this is where should I look at? If you have your total value at risk figures, we all know that the value at risk of one portfolio value at risk of another portfolio is not equal to the value at risk of both portfolios. It can be very different. So somehow it's different from the classic reporting tools, because when you want to drill down, you need really to realize what is the contribution of your figures to the upper one. Somehow you need to understand what is the role and the importance of your portfolio A to the value at risk of the portfolio A plus B, for instance. So that's the type of challenges the risk managers will face when you really want to grasp what are the risks of the banks. Another issue that I illustrated with this little picture is when we're talking about enterprise risk, the number of data is huge. So when you want to find something in the middle, it's quite often the same problem as finding a needle in a haystack. It can be very challenging if you don't have the right way to figure where you should look at, and that's the most important point in enterprise risk. So how can you avoid this trap, and how can you better access and understand your risk? At MyZis, we have chosen 3 words to illustrate what are the driver of a very great risk management system. We have chosen 3 things. The first one is illuminating. What do we mean? If I'm back to my example of this needle in a haystack, it can be very cumbersome to go through the haystack and trying to find the needle. But if somehow you have a way to just illuminate this needle, then it's much easier to find it there. So somehow by the concept of illuminating, what we mean here is that what is of interest from a risk manager point of view. And most of the time, the biggest interest of the risk manager is what is my biggest exposure, or what is the biggest change in the contribution of an exposure. So somehow here, behind the concept of illuminating, the goal is to better understand the risk that you have across the banks, across the business lines, for instance. I will come back on the few next slides to illustrate pragmatically what I mean by illuminations. The second point is, of course, interactive. Interactive, we have seen over the last, I would say, 10 years, that in risk management, 10 years ago, basically most of the people were using a fixed reporting tool, providing figures with some breakdowns, but breakdowns fixed. More and more people need to have this interactivity to be able to really first visualize the risk from one place, and then when they spot that one of the risks is maybe wrong or one of the risks have dramatically changed, they want to access to the details of the information, and this very, very quickly, because they don't have the time to wait for next week or to wait for 2 months of analysis and trying to understand why the risks have changed. The board, the risk committee, will very quickly come back to risk manager to say, oh, we have seen that the risk has changed. You have to explain us why. So the last point is somehow the sum of the 2 first points, which is how to provide more intelligence in systems. Because at the end, when we're talking about risk, we're talking about culture, but the underlying process behind is really the systems that are producing the figures. How can we provide more added value to the end users? How can we bring more control, more proficiency in every single component that you have? So, of course, the goal here is to enhance the way a bank is managing the risk, and to do this, it goes through the first step, which is understanding your risk, and understanding by really grasping the meaning of it. Somehow you have to be a kind of risk insider. You really need to know all the information around risk. So I want to illustrate this in the next 10 minutes by just focusing on one example, but this can be applied to many other cases. We have done so a kind of risk explainer, and I will go with you through the main challenges we are facing. And when I'm saying we, I'm talking as a bank. As a bank, you have always a problem of volumes. Again, here I'm not talking about the first part of gathering data. I'm talking about the time after you have computing your risk figures. If I illustrate this by just a very simple and basic examples, if I take a portfolio, or let's say a trading room, where you have only 10,000 financial transactions, you see here the number of pricings you have to do depending on the measures you want to see. If you just want to compute a historical value at risk, usually people will run 250 scenarios as of tomorrow, so somehow the number of PVs in that case is 2.5 million data you will produce. If you want to compute a Monte Carlo VAR, well, then in that case you need 10,000 scenarios if you apply brute force, which means 100 million data. If you want to use more complex measure, so for instance an expected positive exposure, in case you want to compute, for instance, your potential future exposure of a counterparty, then if you use again a brute force, you will have 10,000 scenarios, and you may do the pricing for the next 50 dates in the future to have the profile of your exposure. But if you do so, the number of PVs you have to compute is 5 billion. I put beside the problem of computing the PVs, okay, because there are technology to do this, but that's not the point of the presentation today. But if we focus just on the number of data you have, if you just want to look at your total historical VAR, you need one figure. But as soon as you have a question, it's 2.5 million of data you need to manipulate to be in a position to drill down and, for instance, to understand the contribution that one deal may have to the total figure. And worse, if what you want to do as a risk manager, for instance, to compare what is your historical VAR as of today compared as it was at the beginning of the month or as of yesterday, in fact, you need twice this amount, 2.5 million multiplied by 2, 5 million. And the more you go for sophisticated measures, the bigger the number of data are. If I take my EPE, for instance, example, 5 billion of data, if I want to do a comparison between yesterday and today, then it's 10 billion of data. To give you an idea, in terms of size, 10 billion of data is somehow a DVD that you are manipulating constantly. So it's like moving from the beginning to your DVD to the end of the DVD, and this as quickly as possible. So if you want to manipulate your data to really understand and explain this, you see that here the technology behind big data is really important. And that's why we are hearing on the market this buzzword of big data, because you have absolutely no way to go without those technologies. At one point, either you just focus on the total figures, but then it's impossible to really understand your risk, or if you want to really understand it, then you have to go to this manipulation of data. So that's one of the first challenges you have. Of course, the other one is the on-the-fly aggregation. Manipulating data, okay, you can probably find a way to do that. But the thing is that if you want to understand your figures and you need to drill down, it has to be very, very quick. You don't want to click and try and wait for 5 minutes, 10 minutes, relaunch your reporting, for instance, and so on. You really want to go through it instantaneously. So in that context, you have the problem of manipulating and storing the data, but also to aggregate this in a very efficient way. That's why here in terms of technology, it's very important when you want to either to build your own risk reporting framework to think about those two challenges: how to manage the volumes, how to drill down. But this is still a classic problem of reporting. But classic reporting for me is just the end. People want to just immediately see what they're looking at. The best example I'm using, and I know lots of people may use it in different contexts, but the best example is to draw a parallel with the smartphone. If you think about the smartphone, between what happened during the last 2 to 3 years, more and more the smartphones are designed so that you can just choose what kind of information you want to have on your smartphone. Somehow, for instance, you have great applications and you just have to push and to say, okay, what is the weather? And the smartphone knows where you are and can just provide you the weather where you are right now for the next hour or next days. So here you don't have to go through something to search to say, okay, by the way, I'm looking at France, at USA, I want to know the weather in London. The smartphone knows where you are. The smartphone assumes what is your key question and what you are looking for, and just give you the answer without even asking the question. That's the change I see more and more in banks. You want, as a user as a risk manager, as somebody who is interested in risk, you want to have the answer to your question as quickly as possible. That's what I mean by illuminating exposures. I know, for instance, that a risk manager who is looking at market risk, and when he's looking at value at risk figures, his first question is, my VAR figures, have they changed compared to yesterday? Because if the answer is no, and it's roughly speaking the same, then no worries. I can do very urgent tasks, and then I can come back and analyze my figures. But on the opposite, if the answer to my question, has my value at risk figures changed since yesterday? If this answer is yes, and it has changed a lot, then I really want to know exactly where to look at. And again, think about the number of data I was speaking before. If you have 5 billion of data, looking at them one by one is just not possible. You will need years to go through the data and to validate them one by one. So somehow you have no choice. Whatever the system you're using, the system has to push to you directly the answer to this question. And if you think a little bit, what are you looking for? The first thing as a risk manager in the context of my example is, okay, but maybe I can have a look at what happened from a trading view. From a trading view, what I mean here is, first thing I need to check is, what are the trades that we have inserted yesterday? What are the trades that have been modified? What are the ones which have disappeared because, for instance, they have matured, or they have been terminated with a counterparty? So here, one of the biggest information you may want to see is, okay, but what happened as new financial transactions, and what is the impact on my figures? Well, in fact, not really on my figures, because your question wasn't, what is my VAR figure? Your question was, how big is the variation of my value at risk? So in fact, what you're interested in is not the contribution of the deal to the value at risk as of today, but in fact, you're interested to understand the contribution of this transaction to the variation of your value at risk between yesterday and today, which is a slightly different problem, but this is really the question you're asking as a risk manager. So for instance, here, one of the ways to eliminate those exposures is somehow to find a visual way to show to the risk managers, okay, I see that the big squares are somehow where the impact is the biggest. And this is here what I mean by illuminating the exposures. If you remember the drawing with when I was drawing the parallel with the needle in the haystack, here it's exactly the same. If you can just illuminate the needle, then it's easy to find it. If you don't, then you can just go and try to find it, but it will take you ages. So that's here for me how we change the way we can manage risk by really changing the way we report figures. I've added as well another example, which is more what-if scenarios. I have also seen lots of questions from risk managers, which is, okay, great, you can eliminate the exposure, so we have seen I can understand my risk, it's great, I can understand which transaction is contributing, is it a big contribution, small one, and so on. Great, I know where I am right now. But the question is that due to the regulation push, due to the best practices we want to put in a bank, I will have questions from the business, which is, okay, but if I want to take this position, how does it impact the risk figures? If a trader has to comply with, for instance, a sophisticated risk measure for the potential future exposure, for instance, the question is that if I want to fund the bank with a transaction, should I do it with this counterparty or the other counterparties? Or another case is that if as a bank we believe we have a huge exposure against, for instance, counterparty XYZ, and we would like to decrease this exposure, question is that how can I remove and which transaction should I terminate? Because obviously if you have an exposure against a counterparty, it may be very difficult to terminate all the transactions, but maybe one of the transactions is having the biggest contribution. So in that context, you also have to think about the kind of dashboard and risk explain you want to really use. So here again, it's a kind of very simple screen where you can visualize the total exposures you have in terms of future exposure. And again, by here illuminating not the exposure but the contribution on a transaction basis, then you know that if you remove my biggest IRS, which is in fact the biggest contributor to my risk measure, then by removing this one, I can significantly decrease my exposures. So you see, when we are talking about collaboration risk management, in fact, we are really talking about the end of the classic reporting tool. In risk, clearly that aggregation is a discipline. The discipline itself, because the problem is not really a technical problem. You have a piece of technology to solve, for instance, the storage of a huge number of data. You have piece of technology to do aggregation. You have in-memory analytics. You have business intelligence tool. But the key is how do you align all those pieces for the final goal, which is how to put the risk at the center of the bank. How can you provide a better understanding of the risk to the risk committee, to the board, for instance. And that's for us what is very key. So somehow, if I can summarize this, the goal of the risk collaboration management is really to provide inside information on risk and to eliminate exposures so that the risk managers can really collaborate efficiently in the bank, can be seen as real player in the bank and as trustable part of the bank. And by doing this, then we can have banks which are much safer, who understand their risk, who can adjust quickly their risk appetite to their final goal. Okay, thank you very much for your attention, and I think we will now try to see and to switch to Q&A.
Yes, we will indeed, and thank you very much, Thierry. Thank you, Payman. Thank you to all our speakers, indeed, for the research angle at the start and the technology perspective at the end there. It's a fascinating discussion. And now let's move on to our Q&A session. I can see we have a number of questions here already for our speakers, but if you do have a question, please just type it into the box on your console, and I'll put it to them. We'll try to get through them all today, but if we run out of time, we can perhaps get back to you online. So without further ado, we've got about 5-10 minutes for questions. And the first one, I think, is to you, Payman, and it was just asking what you think was the key finding in the Chartis research and what perhaps surprised you, if anything.
I think, from my perspective, I think the surprising one was this concept and this the consensus amongst the respondents around the regulatory pendulum having gone too far already, and that wasn't just from a cost and effort perspective, but actually it's a source of risk. You know, risk professionals finding that they don't have enough time to manage risk because they're just doing compliance activity. That was that was very surprising for me, and was an unexpected result. As a sort of general learning from the research, I think the takeaway would be this issue of getting the right balance in terms of change the bank versus run the bank, and if there's an overemphasis or a disproportionate amount of investment with regards to short-term running the bank, compliance, tactical activities, there's a danger, and I think we got to this point just before the financial crisis, that financial institutions will end up with many, many silos of project-based databases and systems, not compatible spaghettis, which actually then they themselves become an operational risk, and it becomes very difficult to get an enterprise view of the institution and to actually manage risk in a collaborative way. So I think getting the right balance between tactical and strategical activities is probably a key takeaway.
Yeah, thank you, Payman. I mean, that's an argument I've certainly heard in terms of keeping the lights on, as it were, and still finding areas for new investment and innovation. So that's a great answer. Thank you. We have another question that's came in, just asking about technology, and it says, what technologies do you think are the key drivers for the development of a collaborative risk management approach? So, for instance, is so-called big data analytics a contributing factor in its rise?
Yeah, I think so. I think the concept of enterprise risk management is not new. It's been around since probably the mid-90s. And I remember as a consultant we used to consult about it, but it was quite nebulous and consultative. But the reality of it is, to implement such enterprise-wide framework, technology is a key enabler, and the technology has caught up. So big data technology, and I think Thierry was touching on it. If you look at the typical technology stack that's required for collaborative risk management, you've got the data management stack around data integration. Data integration is key, because really, in a typical financial institution, you're looking at multiple sources, data feeds, files, databases, spreadsheets, models. These all need to come. These are raw data that need to come in a way that into a single repository or a unified platform that makes sense of it all. And they have different levels of. It's not just the volume of the data; it's also the variety and complexity. Mm-hmm. And then increasingly, the third dimension of that data integration issue is the speed that I mentioned. To do this in real time or near real time, particularly in the front office and trading environments, it's quite a challenge. So there's a whole data management aspect of it. Then continuing on the technology stack, the middle part is around analytics, data aggregation, in-memory analytics, which I touched on. Mm-hmm. And the bit that shouldn't be underestimated, which I think Thierry touched on, is the whole visualization. Risk is a very visual subject. I mean, the numbers are important, but also the visualization, the trend analysis, the dashboards, to really go towards this decentralized, collaborative model. You do require user interfaces which are intuitive and information which is consumed very quickly by the end users.
Yes, yeah, you have to be able to use the information. So.
That's right. I mean, I think, while it was just in the, risk management was in the realms of the risk function or the, advanced quants, the rocket scientists, you could, probably get away with unuser-friendly systems. But I think true collaboration comes from everybody getting involved in risk management, and that is a different sort of UI requirements come out of that.
Okay, that's interesting. Let's perhaps get Thierry involved in this point, because we have another question just asking about what the essence of collaborative risk management is and that approach. And I think what they're saying is that they don't quite see how it's different. So is it a case of the technology catching up with the concept? What makes it different, perhaps, Thierry?
Yeah, good question. And this is also linked to the other question, which is it the end of paper reports, or should we equip management boards with interactive reports only? By collaboration here, indeed, I think this is the end of paper reports. Of course, we will keep it because that's the basic. But by end, I mean that we clearly see that this is not sufficient. Most of the industry were used to only produce so-called paper reports, something which is fixed, producing the figures, and running every day and providing this information. But this is only about pushing data. You're pushing data. If you're pushing data, you have no interaction, so you have no collaboration. So the drawback of this that we have seen clearly everywhere in the industry is that risk managers were more or less pushed into their ivory tower. And we have seen the danger of this. So the only way to change this, and when people are talking about risk culture in banks and so on, it's all about how you don't just push data, but you really collaborate. And for me, behind collaboration is not just exchanging information, okay? Because exchanging information is messaging tools, it's just speaking, but it's much more than this. It's really sharing culture, so really understanding your risk deeply. So my point on this is really, by risk collaboration, is first step is really to have the capabilities to understand deeply your figures, so to have the capabilities to drill down as you want, but in a very meaningful way and quickly. And of course, more and more this will replace reports. That's static reports, that's for sure.
Yeah. Interesting. Okay, thank you. I'm conscious we're actually running out of time now. We do perhaps have time for just one last question and a quick answer. Thierry, perhaps it's you again, but I can throw it open to the panel. And it's really about integration, and the question is asking about how you can integrate your risk software, your people, your programs into one cohesive whole, so you don't get these silos that we've been talking about that adversely impact the bank during the migration process. So is that something that you think is a pertinent question?
Well, definitely. But very short answer due to the time constraint. Yeah. Basically, two directions you have to think. One is how to be closer to front office and trading environment. That's, for me, key. So basically, how can you share analytics to compute your risk figures? So the more you can share pricing libraries, the best it is, because you speak the same language. And the second one, which is about integration. Integration, when you do integration, never do integration just from a technical point of view. You really have to start from the end of what do you want to get in terms of reporting, in terms of how you want to understand your figures, and this should drive your integration process in that context.
Yes, excellent. Yes, otherwise you end up with a kind of expensive widget which is perhaps not integrated. So,
exactly.
Wonderful. Okay, gentlemen, thank you very much for your time today. I do apologize, we're actually out of time now, but this recording will be available afterwards, and I would like to thank you both for your participation. Thank you to our sponsor, of course, to MISIS, and for Chartis for their research. And I would like to thank our listeners for joining us today on this bobsguide webinar. Thank you for attending, and we look forward to welcoming you to another bobsguide webinar in the near future. Bye-bye.